Welcome back to Focus Fridays, the series where we open up the playbook on real estate investing, covering everything from core fundamentals to the sophisticated strategies that help our investors grow wealth with confidence. I'm Jared Chubb, Head of Investor Relations here at Focus Capital.
And I'm Chad Sheeler, founder of Focus Capital.
Chad, so far we've talked about what real estate investing is, how much money you need to get started. Today we're tackling another concept that people hear about all the time but don't always fully understand. What is cash flow? And why does it matter? So let's start off simple. When investors talk about cash flow, what are they actually referring to?
Cash flow is referred to really what's the cash produced from the property after your income, your expenses, what's left over at the end of the day. And what can I earn on a monthly or annual basis relative to the money I put into the property to purchase it.
Gotcha. And so if expenses that you had referenced earlier are higher than income, that's negative cash flow.
That's a bad thing.
And which investors generally want to avoid.
Yes.
So why do so many investors prioritize cash flow?
The reason why I do personally and most investors do is because when you've got reliable cash flow coming in on a property, that means more of your return is coming from something that's less affected by appreciation that you may be banking on. So it presents a less risky investment overall because you've got cash flow coming in to where you can weather storms. You know, if you have no cash flow at all and things break, things come up, you're coming out of your pocket to put more money in the property again instead of producing cash flow to cover on its own. It's more of a stable investment.
Gotcha. So let's double tap into that. A lot of people ask this question, cash flow or appreciation, and which one matters more?
I mean, you want both in a real world, right? You want both to be able to grow your investment, your equity appreciation over time. But having substantial cash flow, I'd say at least to a fourth to a third of your overall investment coming from cash flow is where we want to be at minimum.
From a general landscape, just using like whole round numbers, how does an investor typically, like back of the napkin, how can they calculate cash flow on their own when sizing up a deal?
Yeah, pretty simple. So let's say the property produced $5,000 a month in cash flow. That'd be $60,000 a year in cash flow. And let's say that you had to put in $600,000 into the property to purchase it. Well, that'd be 10% return, cash on cash return your money that year.
Perfect. Okay. So for passive investors, why is cash flow especially important?
It's important to them because they want to get that cash flow each year to maybe live off of, to increase their passive income. A lot of investors we talk to, they want to increase their passive income to basically fund their whole lifestyle. They have this goal of, okay, how can I essentially become financially free to where my passive investments are kicking off enough cash flow per month or per year to cover all my living expenses.
So if someone is looking at, in investing in a property for cash flow to have some residual income and non-active, form of income, would there ever be a situation where a lower initial cash flow could still be acceptable for an investment property?
Repeat that again, sorry.
Yeah. So you had said one of the main reasons why passive investors, prioritize cash flow is because that might be what they're living off of. They might not be actively working anywhere. They might not be a W-2 earner anymore, but their goal might have been to have all of their investments cash flow enough to sustain their lifestyle. So in that same lens, are there ever situations where a lower initial cash flow on a property is still an acceptable investment and still seen as a good investment long term?
Yeah, 100%. Not every investor that we have talked to or have currently cares the most about cash flow. In fact, I say a lot of my investors, they already have income sources from other places, other jobs, other income that far surpasses what an investment here would produce. So for them, they're more doing this for a tax play or more appreciation play, and they could care less about cash flow in the first couple of years. It's obviously important then the property will produce cash and it's cash flowing from day one, but it's not absolutely imperative. Does that make sense?
Yeah. So when you say day one, does that mean that I get distributions like right away? Like what do you mean cash flowing from day one?
Great question. No, it does not mean distributions day one. That's not usually how it works here, or anywhere for that matter. But cash flowing day one means the property itself is producing some level of cash on the day one, the day we take it over. Right now, distributions may happen 2 months, 3 months, a year later, depending on when it's stabilized. But the property itself producing cash day one is a good metric to look at first of all, to where it's not negative cash flow.
And from your perspective as an operator, and then also as someone who's invested, what amount of that cash flow from the property is usually held in reserves for, a rainy day or a broken pipe or something like that? And then what is distributed out to investors?
Great question. This is where a lot of people make mistakes. It's where I made mistakes earlier on as well, is you have to have sufficient reserves to weather storms because things come up. And it's better to be prepared for that than to have a dip in your pocket or do a capital call to fund those things that come up. I would say on average, we're going to set aside about 3 months of expenses, if not more, on a property, in addition to capital expenditure reserves, which is for larger expense items like roofs, HVACs, appliances, that kind of thing. But usually 3 months expenses or more is what you want to hold aside in your account.
And for that hold, it could not contribute to a lower initial cash flow or a slower distribution drip in the beginning of an investment?
Exactly. Regarding like a passive investment.
Correct.
Yeah. That is true because as an operator, like our number one job is to protect the asset, to make it run well, and then to distribute leftover cash to investors. And if there's a point in time, the first 6 months or year or 2 years to where the property isn't stabilized yet, it's in our best interest and as fiduciary to hold cash in the property to make sure it can run well first. It's a business after all, right? You don't want to pull cash out on month one without knowing if it's stabilized yet, like you would do it for a business yourself. So holding back cash and making sure it can operate well, so we have a good trend line going forward, then we'll be able to distribute cash to investors.
So there is a situation where a property can be cash flowing or cash flow positive, but there still not be distributions yet. And that doesn't mean that the property is upside down or anything, or there's anything bad happening, but there could be a transitionary period, is what I'm hearing.
Yeah, and I'll give you a good example, actually, a real life example, is we've had a property to where it is coming upon stabilization. It's about a year into its business plan. The loan is going to start having principal and interest payments coming up in about 6 months. And we're looking at a trend line to see, well, right now today it's cash flowing very, very well, quite a bit for investors. But in 5 months, it's going to be amortizing or make principal and interest payments, which will drop that cash flow down for a higher debt service payment. So we're going to wait right now and hold. Let's see what's going to happen with the current expiring leases in the property. Let's see how the current leasing efforts go, make sure occupancy is going to hold firm before we ship a cash to our investors. So you have to look ahead of on the trend line here, the next 6 to 12 months, to see, well, is it feasible to expect to have the same amount of cash flow in 6 months? If we're unsure about that, then either we dial back the distribution amount or we would just pause it and not do that yet.
So taking a wider lens to this, if I'm a first time investor and I don't even know, now I know how to calculate cash flow. How do I know if that's a good percentage? And I know that might vary depending on the asset class and what type of deal it is. But is it like, 2% is great or 10% is standard? Cash on cash return. That's the example that you gave on the back of the napkin math. Like, what is a average and slightly above average cash on cash return percentage that LPs can look out for?
Yeah, for limited partners, I would say the average you're looking for is somewhere between the 5 to 7% range on average throughout the hold period. Year one will probably be a lot lower than that because you're going to start increasing cash flow throughout the years as you grow the property's value and appreciation. I would say if you look at a property that's got 2 to 3% average cash flow, that wouldn't really get me excited about that investment personally, because obviously your risk-free cash flow in a money market account is maybe 4%. Well, that's not tax advantage. There's no appreciation there, no tax play there. But and if it's 10%, that's great. That's amazing. Maybe look at, well, is it reasonably underwritten there? Is that more of a C-class property that won't have as much appreciation? Where I found that you've got a great blend of cash flow and appreciation is usually in the 5 to 7% range, and you have a lot of upside potential as well.
Gotcha. So let's say that something is at, you said between 5 to 7, so let's call it 6% cash on cash return. That doesn't mean that my first distribution would be, or my first year's of distribution wouldn't be at a 6% return.
That's correct. Yeah, and that's a lot of questions we get sometimes from newer investors, and they may think, well, you guys projected that you'd have 7% cash flow over a 5-year period of time, and I divided the math out, and year one 7%, quarter one should be this amount, and we have to show them obviously, okay, the property is increasing in value, we're stabilizing the property. The first quarter of the first year is not going to be proportionally equal to what the fourth quarter will be, right? Because we're going to distribute what's available in the property.
Yeah.
And I think you have to watch out too. There may be some operators out there. This probably goes more into our future podcast about what to look for in an operator. But you got to look at, okay, where are these distributions being funded from? Are they being truly funded from operations on the property and the cash flow derived from that? Or is there a slush fund somewhere or a reserve that they're pulling from to fund those distributions?
Yeah, I think that, something important, like real world numbers, you just talk about an example of our most recent deal that we closed on, Gateway Crossing, had a projected cash on cash return of just over 7.5%. But that doesn't mean that year one was closer to 5.6%, but then year five is over 9%. So that over the lifetime of the asset, over the lifetime hold of the asset, we were projecting for 7.56%. I think it's also important to note that depending on when an asset closes, an LP can also expect a smaller distribution up front anyway, because there might only be two months in that quarter.
Yeah.
And then the next one will be bigger, even if cash flow hasn't changed, because there's a whole additional month. And so things for LPs to pay attention to, because especially if their fund is paying out quarterly, it's good for them to know, okay, this is the reset period. There was a month and a half, there was 6 weeks in this. And so to be able to do that. I think another thing that investors may or may not pay attention to when they see a sample schedule is that they don't see the years on there. They think that that's a monthly or quarterly distribution, and that's what they should be expecting.
Yeah.
Instead of dividing that year one number by 4 and then knowing that that's a projection, that's not a guarantee.
Yeah. Yeah. Projections, not guarantees. So that's a good point you made, Jared. That's good.
A couple more questions and then we'll wrap up here. When it comes to projections versus guarantees, how do you, as an operator, ensure that your projections are as close to what you can deliver on for your investors, both from an operational standpoint and an underwriting standpoint?
Yeah, I mean, underwriting really is where it starts at. And we use really current historical data on how we're currently operating properties as they are and how that's going to impact our current underwriting for newer properties. And operationally, obviously working with the PM companies and different people on these projects to make sure it produces the most cash flow as possible. But it's important to having more deals under your belt and knowing how these deals actually operate and what's realistic versus like what may be ideal or maybe what you want to go achieve. There are two different things sometimes.
And then from a projection standpoint on after you've already underwritten the deal and started raising for it, and so you already have that deck out there, how do you continue to ensure that you're going to be meeting those targets that you projected?
Operations. You got to keep with the PM company to make sure that you operate it well. And there's never any guarantees in real estate or investing. But if you have the right people in place, the right people on your team, the right PM companies in place, and you manage a property well from an asset perspective, then you should do well.
My last question is, and it's a very similar question that I've asked on other subjects, but if you could correct one misunderstanding about cash flow, whether we've already talked about it in this podcast episode or not, what would that one misunderstanding or one myth be that you see being a common misconception among either first-time or even sometimes tenured investors?
Yeah, I think you kind of alluded to it a minute ago, was a lot of people think that on that 5-year projection timeline for cash flow, that maybe first two things. Number one is the average cash flow is the year one cash flow. That's a myth.
Yeah.
And they may think that cash flow amount you see is what they'll be getting every distribution every quarter, which, like you said, is divided by 4. So just understanding that, okay, the cash flow is projected. That's what we plan to do. It's our plan that we set out to do initially. It could change based upon the performance or a lot of different factors.
I think that it's something that operators can do to kind of help assist LPs is be very clear about that. We're very clear when we give a sample investment return with our numbers. And it's like, hey, this is on a quarterly basis, but the numbers you're seeing here are annual. So all you'd have to do is divide that by 4. So for example, your first distribution should be around. Then just verbalizing that, because it might not be a question that people will ask, or they might only scan that slide in a deck and just assume that number, not because there was any, hidden things or anything like that, but they just assume because that's what they're ingesting.
I think one more thing you should look out for too, a myth, is maybe some people will roll in their cash on cash return or their average cash flow using refinance proceeds or sale proceeds as the average, which in reality, your cash flow should just be the cash flow the property produced over that duration, not including the gain from the sale as your cash flow average.
So it sounds like cash flow isn't just about monthly income, but it's also about stability, flexibility, and long-term success in real estate.
Yeah, I think it provides a lot more stability personally.
Oh, perfect. Thanks for listening to this week's episode of Focus Fridays. We release a new episode every week, so be sure to join us next Friday and beyond. If you'd like to see our next investment opportunity before it goes public, you can join our investor list by filling out the form on our website, focusedcapital.com. If you have any inquiries about what we've covered on our podcast, general real estate investing questions, or suggestions for the show, we'd love to hear from you. Feel free to reach out to us anytime by emailing us at investors@focusedcapital.com. Take care, and we'll see you next week.